Michael Yorba, thanks for joining with us. I have Mish Schneider, Director of Trading, Education, and Research for MarketGauge on the show with me today. Mish, welcome back to the show.
Thank you very much. Good to be back.
All right, I'm glad you're here. You want to start off talking about gold today, GLD, right?
Yes, well, I want to follow up with something that Keith has done with you guys for the last couple of sessions, which is really talk about how gold was ready to explode to the upside. And I think today is the first day we've seen really where it has taken out its 30-minute opening range and has held above. Like yesterday, for example, it tried to do that, and then after the Fed announcement, it basically sold off. So the question is this real? Even today, when we had some pops in the S&P, which was becoming somewhat negative for gold, the S&P would rally, the gold would sell off. That didn't happen today. Even when the S&P tried to make a rally, gold actually has stayed firm. So it's really starting to show that it's taking on its own personality at this point.
Yes, that's consistent buying in of that market no matter what is happening with the other markets. I get it. That's a very strong signal. Having traded gold since 1980 myself, I've seen this play before. So have you.
Yes, and this is when gold just takes on its own personality. So, we can talk numbers, but I know from experience, and especially the same year of you at 1980, technical factors become completely irrelevant.
Exactly.
Once it starts going, it doesn't really care about support and resistance. It just keeps going.
Yeah, it's like buying the stock market 9-10 years ago. Everybody said just buy the dips, and we kept coming up with reasons why not to, and all you had to do was just buy the dip.
And that's just the opposite right now, sell the rally. And, that's the other thing is you and I think, had our first conversation about the top October 31st of the market, but we can get back to that. Well, let's just finish up with gold.
Yeah.
Because a couple of things have to happen now with gold. And as far as I can tell, it's above the 200-week, it's above the 200-day. So we really want to see those levels hold. Mm-hmm. The 200-day is a little bit higher. It's trading up at around 118.80, again, using GLD. And I can switch to my chart. Actually, let me do that. Now that we can share charts, we're so official.
There we go. Okay.
Okay, so here's the gold chart that you can see. And the 200-day, which is the green line, is coming in at 118.82. If you move over here to the weekly chart, the green line is now the 200-week moving average, and that's at 117.57. So essentially, on 2 time frames, we have broken out. There's one more time frame that really has to go, and that would be the 23-month, which is the chart up on the top right here. That is the monthly chart, and the blue line that you see is actually the 23-month moving average. And we've been beneath it now since it broke down in the middle of 2018. If it can get back above, it's possible that this thing has really bottomed and we can see a tremendous move up.
Yes, and I don't know if you work with timing in regards to cycles, but do you have when this thing goes, my intuitive feeling, I'm not going to put science on it yet, but my intuitive feeling is that if this goes like this, it may not be a short-term rally. We could be in the beginning stages of something that could go on for a little while, and it could turn into an investing trend rather than just a trading trend.
Yes, and it also goes in sync with a couple of other factors. Number one, obviously, is that it is a relatively safe play, especially since it's been so undervalued. 2 is the dollar has now started to sell off, and that's something you and I have talked about and anticipated. If the dollar continues to weaken, that's going to be a positive for gold. Then you're going to have, the speculative fear of missing out kick in right now. When I first started putting on Twitter that gold was a buy down at around 115, 116, and that was going to be the thing to hedge it if the market was going to sell off, I was getting snide remarks about, oh, come on, oh, please, oh, whatever. And those are always the people that turn around and go, oh, my God, look at gold now. Now it's time for me to get in. So, yeah, all these things could really take gold and bring it up to maybe 125 is really what I would be looking at if it holds here above this 118.80, 119 level.
Okay, that's quite a move from here. That's a pretty good move.
Yes, and really, what does it mean? Now, again, with that dollar, we can start looking at how the rates are doing. Obviously, even though he raised yesterday, was sort of in the market, what they called a dovish raise, because he's talking about holding off potentially next year in 2019. We talked about 2019 being basically the 40-year anniversary of when we had our last major run in commodities. So I would also be looking not only at gold to possibly lead the charge, but I would also be looking at some of those other commodities that have still been really lagging behind. Like, for example, I like to look at sugar.
Okay.
Sugar, and mainly because in 1980, gold and sugar both started the rally at the same time. Sugar had gone from like 10 cents to 40 cents a pound, which was a huge move. And right now, sugar is still floundering, but it's hanging in there. So if you see sugar futures trade above 13, I think that would be a good indication that has bottomed too. So I guess what I'm really saying is, to me, gold is telling me that everything that I have been waiting very patiently for, not that I'm happy to see the market melting down, but I've been waiting very patiently for inflation to sort of catch up and the economy to start slowing down, or a sort of a stagflation could actually occur. And even though economically it's horrible, it is actually very tradable. And of course, that's the whole point, is that we're traders, so we're trying to keep a very objective feeling about what happens and just look, how do you make money in any environment?
Exactly. What about interest rates? You brought it up, you brought the dollar. We haven't spoken about oil yet, but let's start with the interest rate market.
Well, again, let's look at TLTs. So I'll put those up, and we can take a look at that here. So here are your TLTs. Now, what's so interesting is if you look up here at the monthly chart, I'll make that bigger. This cyan line, that is the 80-month moving average, and I love the 80-month moving average. It's probably, of all the moving averages that I use, my favorite, because it corresponds with a cycle of about 7 years, a little under 7 years. And so when you have something that has been above the 80-month for years and years and years, even if it's long beyond 7 years, and it corresponds with a business cycle, and then, of course, it means if it starts to break that business cycle is potentially done. And that's what happened with the interest rates this year. After years of being up, you can see that back here, it broke down under that 80 monthly, and look where it's rallied to right now, right back up to that 80 monthly moving average, and right above it is the 23-month moving average. So this is a very critical point right here, up around 121.50. I think the market is telling you now that people are flocking to bonds, but here's again where it all sort of fits almost too tidy, is that if this is actually the rally because people didn't know what else to go or where else to go, and they were still skeptical about gold, and this starts to actually come off again, then it corresponds with the idea of the fact that the reason why Powell did what he did is because he is aware that things can get out of control with inflation, particularly with a declining dollar, even though he used data points to support his raise yesterday. Economy is still doing okay, the job situation is still good, et cetera, et cetera. I'm looking at it as what happens if the rates now all of a sudden you can see them start to rise again. This is the resistance, and there's nowhere to go because the market is not the place you want to put your money. Potentially gold people are scared of, and now they're getting killed in the bond market because they're all flocked to bonds. The reverse is that takes out this 121.50, and then again I think we can see it maybe a little bit higher, but I'm not really sure I would look more than 125, and that's generous in terms of what would be a target if this continues to go up. Or the TLTs, when they go up, obviously means the rates fall.
What about crude oil?
Oil is just not something. Yeah, it's terrible. Yeah, I mean, I'll show you oil. Let's take a look at oil on a monthly chart, actually. I like the monthly chart these days because you get a longer term perspective.
They're going to be giving this stuff away soon.
Exactly. I know. I filled up my car yesterday, and I was delighted that with high tests, it was so cheap. But you can see this 80 monthly, obviously it stops here. But if you projected that oil has been underneath the 80 monthly since like 2007. And now it looked like maybe we were going to try to make a stab at it when it broke the 23-month here. But you can see what happened. It just sort of petered out, and now here we are down here. Now, the thing is that we're not at the lows yet. That low is 767. That was made in 2016. So I wouldn't touch oil right now unless it came back through 12, which would mean that it would come back not only through that 23-month moving average, but look how much it would clear in terms of all the work it did from 2016 until that rally that we had in early 2018. We get through 12, you're certainly not missing the boat. That would be the point to say, hey, maybe things have turned around in oil. Otherwise, I wouldn't touch it.
Okay. All right. What about, what we're looking at right now as we're getting into the S&P? It's really going to start to spook people right now. Let me pull up my chart, and you can tell me what your thoughts are on that.
Okay, and I'm pulling up mine at the same time.
Yeah, because we've got at least a 400-point drop in the Dow. We've come from 2947 at the high. When you and I were talking about a top, let's see, back in September, is where the ultimate top is, to 2458 now as a new low for today. Are we looking at something that could really potentially be a waterfall motion? I mean, where's the Christmas rally? But, I don't think we're going to get one.
No, I don't think so. I think Santa's reindeers are on strike. Just the opposite. Well, again, let's take a look at this monthly chart, because we've obviously broken down on everything except for the monthly and the weekly. Mm-hmm. So let's blow the weekly up first. Let's go. Come on. All right. So here we are. When you and I talked, it was here, long before it actually took out that 50-week moving average. We were anticipating that. And we were anticipating on the topping pattern there, and the fact that while the Dow was making new highs in October, IWM, the Russell 2000, wasn't. So that was a brilliant call. And also you had mentioned your friend who was on board with that too and had sent some paperwork. So yeah, it was great. And it was great to be well ahead of the curve and go short up there. The question is now, are we going to find any kind of floor? If we see here, we're a little bit oversold, not so much on the weekly, but definitely on the daily. Mm-hmm. And we're looking for a type of blow-off situation. When everybody starts to look for the exits, that's when I say the public always buys the top and always sells the bottom. That's just has been since the beginning of time in the markets. I've seen it over and over and over again. And so all the bulls that I have known who have stuck to their bullish guns up until this week are now bearish. That tells me that when they throw in the towel, it's time to start thinking, where's the blow off? So here's what I'm looking at right now on the monthly chart.
Okay.
First of all, look at the monthly volume patterns we have here. So we're having huge monthly volume the last 3 months. Whoops, sorry about this. During this whole breakdown here. So now look at this. This is a channel that went back to 2007 when it broke out the top of it after the election in 2016, early 2017, and look where we're retracing right now, right to it. Mm-hmm. So this 245 level in SPY is important. So one or two things can happen here. If it holds and we start to see any kind of buying coming into the market at these levels, we would want to see a green day with big volume in order to say, some kind of bottom is in. However, if we just pop a little bit and work off some of those oversold conditions, then there's no reason why this channel can't break. And here's your 80 monthly moving average, and we can get all the way back down to where we were in 2016 before the election, which is down at around 210. Got it.
Okay. IYT?
Okay, and the reason why I'm showing you IYT as opposed to the others is because, look, this is all the modern family, so it's great to be able to show the charts because we've been talking about this for so many weeks. They're all incredibly broken down, and again, when you and I talked, none of them were. So right now, just take a look at the Russell's below the 200-week. IYT will get back to is below the 200-week. XRT is well below. SMH is the only one that isn't. KRE, which started the whole ball rolling, is below. And of course, IBB just got absolutely killed, but that's where you have your specs. Buy the highs, sell the lows. That's just so indicative and unfortunate for them. If they knew about phases, they wouldn't do that. So if we look at IYT, let's just take a look at it on a bigger time frame here and go to IYT right here. So first of all, look at where we're coming into some support here around 160. Mm-hmm. Again, if we're going to get any kind of blow-off bottom, not only do we want to see it hold 160, but on the weekly basis, and remember, tomorrow's the end of the week, if we could get any rally and get this closed back over 163.88, where the 200-week moving average is, then it's possible we'll start to see people scrambling back in and looking for bargains. But right now, I wouldn't do that. That would be the only thing that I would do to anticipate that.
And if we don't?
And if we don't, well, if we don't, sorry,
exactly.
Yeah, oy vey, as they say in
That's
New York.
all you can say.
Right, exactly. My Keith keeps talking to me, and I'm sorry, it's distracting.
It's okay.
But
Tell
he's
him
got
he'll
a
be
lot
on
to
tomorrow.
say. Honey, you'll be on tomorrow. No, he's just trying to be very helpful. Anyway,
kidding.
Here, back to that 80 monthly moving average in the business cycle. Here we go, 146.45. That's where it comes in. It's inclining, so figure somewhere around 147. Under 160, that's probably our next stop.
Okay. SMH, I think, is the other.
Right, and that's only because this is the only one that A, has held that same channel that I showed you in SPY that goes back to about 2010.
Yeah, but we just crashed through the support that was held back from October.
Absolutely. It depends on what time frame you look at. Well, right, if you're looking at the daily chart, it looks awful.
It does.
But if you're looking at the monthly chart, though, we're right here at some critical support. And I have to tell you, in 2012, semiconductors started the whole ball rolling in terms of the rally. Really, they were the first ones, besides IBB, to bottom. But IBB bottoming at the same time as semiconductors is unusual. So I take the credence of semiconductors as far more important because it's tech. And obviously, we're a very tech-dependent world. Mm-hmm. So if this can, A, hold where I just showed you the channel, which would be somewhere around this 83, 84 level, then it's the only one that has not broken that 200-week moving average. So that would mean that we'd want to see it first take back the low that we had from a few weeks ago, which was 86.95. If it gets back through 87, again, maybe some relief. If it doesn't, once again, where is the magnet? The magnet is going to be back down to this 200-week moving average at around 76.40. So that's a lot to digest at this point. So essentially, really, if we had to sum it up, it would be, A, we're not showing any signs of a blow-off, but there's always the potential because, as you know, as everybody starts thinking the market can't ever go up again, sometimes it's really surprising. Not to mention in a bear market, you can get 10 to 15% rallies and it'd still be a bear market. Mm-hmm. Number two is we're going to keep our eye on the dollar continuing to decline, what happens with the gold, and what happens with some of the agricultural commodities, particularly sugar, as some kind of a fortune teller of whether or not inflation will pick up at all. Because even though the global demand is down, psychologically people get into a hoarding mentality with raw materials when things get rough, and that makes sense. So either that will be averted because the market tries to bottom and people feel a little bit more relief, or it won't be averted. Any rallies continue to get sold tremendously like we're seeing now, and then we start to look to the gold, to the sugar, to the dollar to see where our next opportunity is in possibly buying some of these commodities.
Got it. Mish, thanks for all of the information. We're going to stay tuned with you. And I can't wait for the next interview that we have on this one. Great conversations with you today.
Thank you, and have a wonderful, healthy, happy holiday, both of you, and a very happy new year.
As long as I'm on the right side of the market with you, it's going to work out that way.
Okay, great. We'll make sure we're together when the bottom is in.
Good.
Okay. All right. Take care, guys.
Thank you.
Thank you.
You've been watching CEO Money with Michael Yorba. Thanks for following with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.